Hello students, in Principles of Insurance, we have a lesson by name Insurance Contract. In today's lesson, let us focus on insurance contract terms. Let us focus on the principles of insurance, namely principle of insurance interest, principle of indemnity, principle of subrogation, principle of contribution, relevant information disclosure, principle of utmost good faith, relevance of proximate cause. So, let me start with the insurance contract terms. Almost all contracts share fundamental concepts and basic elements. Insurance contracts typically possess a number of characteristics not widely found in other types of contractual agreements. The most common of these features are aleatory is one term which we come across in insurance. Aleatory, if one party to a contract might receive considerably more in value than he or she gives up under the terms of the agreement, the contract is said to be aleatory. In insurance contracts, depending upon chance or any number of uncertain outcomes, the insured may receive substantially more in claim proceeds which was paid to the insurance company in premium. So, that is regarding aleatory. We come across another term by name adhesion. Adhesion. Adhesion means insurance contract is characterized as one of adhesion terms and provisions are fixed by one party who is the insurer and with minor exceptions must be accepted or rejected by the other party, prospective policy owner. It means insured must accept the entire contract with all terms and conditions of the insurer without any bargaining. So we have to accept all the conditions, all the terms and conditions without any bargaining. So it is called adhesion. Next, utmost good faith. Utmost good faith. Although all contracts ideally should be executed in good faith, insurance contracts are held to an even higher standard, requiring the utmost of this quality between the parties. Each party must have a reasonable expectation than the other party. That means we should not defraud, mislead, or what we call conceal information. Indeed, we should have good faith, utmost faith. In a contract of utmost good faith, each party has a duty to reveal all material information. And if any such data is not disclosed, the other party will usually have the right to void the agreement, to cancel the agreement. Next, executory. Executory contract is one which the covenants of one or more parties to the contract remain partially or completely unfulfilled. Insurance contracts necessarily fall under this strict definition. Of course, it is stated in the insurance and agreement that the insurer will only perform its obligation after certain events takes place. That means any loss or any takes place, then only he can perform the obligation. So it is executory contract. Okay. Next, unilateral. Insurance contracts are unilateral. The insured performs the act of paying the policy premium, and the insurer promises to reimburse the insured for any covered losses that may occur. It must be noted that once the insured has paid the policy premium, nothing else is required on his or her part. No other promises of performance were made. Only the insurer has covenanted any further action, and only the insurer can be held liable for breach of contract. So these insurance contracts are unilateral. So once the insured pays the premium, then the whole responsibility rests with the insurer, and he has to pay any claim or what we call the insurance benefits to the insured. If he fails, then means he is liable for breach of contract. The company is liable for breach of contract. Next, conditional. This is the term which we come across. A condition is a provision of a contract which limits the rights provided by the contract. In addition to being executory, aleatory, adhesive, utmost good faith, insurance contracts are also conditional. When a loss is suffered, certain conditions must be met before the contract can be legally enforced. For example, the insured individual or beneficiary must satisfy the condition of submitting to the insurance company sufficient proof. Any loss has taken place, you submit the proof. They have to satisfy. The company has to satisfy, prove that he or she has an insurable interest in the person insured. That means these are the things which we have to prove ourselves. When you prove that you met all the conditions, then you can claim the amount. So they are all conditional. Okay. So all insurance contracts are conditional. Personal contract. Insurance contracts are usually personal agreements between the insurance company and the insured, that is individual, not transferable to another person without the insurer's consent. The company has to give the consent, then only you can transfer. Otherwise, as an individual, I can't transfer. So they are all personal contract, and also they are all personal agreements. Valued policy. Unlike property insurance, life insurance contract is a valued policy, which means the insurer agrees to pay a stated sum of money irrespective of the actual economic loss, which is opposite to the contract of indemnity applicable to property insurance. Is a valued policy. Next, essentials of an insurance contract. According to the Indian Contract Act 1872, a contract is an agreement enforceable by law. All agreements are not contracts, but all contracts are agreements. An agreement may be legal or illegal. Only agreements which are legal are enforceable in the court of law. As soon as a party enters into a contract, automatically his rights and duties will arise. To make a valid contract to be enforceable by law, we have certain essential elements. We have to follow them. For example, the essential element for a contract is offer and acceptance. To make an agreement, there should be different two parties, that is, insurer, the company, and the insured, the individual. The applicant for insurance makes the offer and the company accepts the offer. This accepting procedure is different for property, liability insurance, and life insurance. In property insurance, the offer and acceptance can be oral or written, and the agents have the power to bind their companies through the use of a binder, which is a temporary contract. In life insurance, the agent does not have the power to bind the insurer. The application for life insurance is always in writing, and it should be approved by the insurer before it is in force. Consideration. Consideration means something in return. Both the parties to the contract should get something in return. It refers to the value that each party gives to the other. The insured consideration is payment or a promise to pay the premium and an agreement to abide by the conditions in the policy. Generally, it's a simple statement that the insured has completed an application, paid premium in exchange for the company's promise to provide insurance. So, as an individual, when you are filling the form, when you are paying the premium in time, then you have the right to claim any damage or to take the matured amount from the insurance company. So, you are fulfilling your duty, you are paying the premium. So, therefore, you have the right to get your claim, or you have the right to get your mature amount from the insurance company. So, therefore, it is something in return. Consideration means, it refers to the value that each party gives to one another. Next, coming to legal capacity of parties, or we can say competence of parties. The parties to contract must be legally capable of making a contract. The incompetent parties are minor, lunatic, intoxicated person, or person under the influence of drugs, convict, etc. These people are not legally competent to enter into insurance contract. Legal formalities. To be a valid contract, a contract of insurance must be for a legal purpose and not for public policy. All illegal activities which are contrary to the public interest are not enforceable. The purpose of an agreement must be lawful. Gambling transactions are illegal. They are unenforceable by law. Illegal drugs. Seller cannot take a property insurance against the stock. Insurance contracts are specialized type of contracts. Essentials of a valid contract. Insurance contracts are subject to additional principles like principles of insurable interest, principle of utmost good faith, principle of subrogation, principle of proximate cause, etc. So, now let us focus on the principles of insurance. Insurance may be defined as a contract between two parties. One party, called insurer, undertakes in exchange for a fixed sum called premium to pay the other party, the insured, a fixed amount of money after happening of a certain event. Insurance policy is a legal contract. Its formation is subject to the fulfillment of requisites of a contract defined under Indian Contract Act 1872. We have 9 principles. One by one, let us discuss. First principle is nature of contract. Nature of contract is a fundamental principle of insurance contract. An insurance contract comes into existence when one party makes an offer or proposal of a contract and the other party accepts the proposal. Second, principle of insurable interest. Under this principle of insurance, the insured must have interest in the subject matter of the insurance. Absence of insurance makes the contract null and void. If there is no insurable interest, an insurance company will not issue a policy. An insurable interest must exist at the time of purchase of the insurance. A creditor has an insurable interest in the life of a debtor. A person is considered to have an unlimited interest in the life of their family members. So these are the things which we have to keep it in mind. Unless and until, as an insured, if I have insurable interest, then only I can take a policy and the company will issue the policy. If I am not having any insurable interest, then the company will not come forward to issue the policy. Principle of indemnity. Indemnity means security or compensation against loss or damage. The principle of indemnity is such a principle of insurance which states that an insured may not be compensated by the insurance company in an amount exceeding the insured's economic loss. So, if the loss is 50,000, I can't claim more than 50,000. I can claim up to 50,000 only. In insurance contracts, the insured would be compensated with the amount equivalent to the actual loss and not the amount exceeding the loss. The purpose of this principle is set to back the insured to the same financial position that existed before the loss or damage occurred. Principle of subrogation. The principle of subrogation enables the insured to claim the amount from the third party responsible for the loss. It allows the insurer to pursue legal methods to recover the amount of loss. If you get injured in a road accident, reckless driving of a third party, the insurance company will compensate your loss and will also sue the third party to recover the money paid as claim. Principle of contribution. The principle is a insured can claim the compensation only to the extent of actual loss, either from any one insurer or all the insurers. As per the doctrine of contribution, the indemnity provided for the loss occurring other asset which is insured with several insurers has to be proportionately shared among them according to the rateable proportion of the loss. The amount of total compensation or indemnity provided to the insured by all the insurers should not exceed the amount of loss. So it is very much equal to the principle of indemnity. Here, as an individual, you can claim the total compensation, okay, and you can't exceed the amount of loss. What is the loss? 1 lakh. You can get up to 1 lakh, not beyond 1 lakh. So you can, it is the principle of contribution. It is the doctrine of contribution provided for the loss occurring which is insured with several insurers has to be proportionately shared, and you can get the amount not exceeding the amount of loss. Principle of disclosure, material fact of every circumstance or information which would influence the judgment of a prudent insurer in assessing the risk, or those circumstances which influence the insurer's decision to accept or refuse the risk, or which affect the fixing of the premium or the terms and conditions of the contract, must be disclosed. So we should explain everything in a proper way. We have to give all the evidences, everything, whatever the company asks, we have to put it before the company, and this is called the principle of disclosure. So therefore, based on the facts which we give, they issue the policy. Principle of utmost good faith. Under this insurance contract, both the parties should have faith over each other. As a client, it is the duty of the insured to disclose all the facts to the insurance company. Any fraud or misrepresentation of facts can result into cancellation of the contract. Principle of proximate cause. Proximate cause literally means the nearest cause or direct cause. This principle is applicable when the loss is the result of two or more causes. The proximate cause means the most dominant and most effective cause of loss is considered. This principle is applicable when there are series of causes of damage or loss. Principle of loss minimization. According to this principle of loss minimization, insured must always try his level best to minimize the loss of the insured property in case of uncertain events like outbreak of or fire outbreak. The insured must take all possible measures and necessary steps to control to reduce the loss in such a situation. The insured must not neglect and behave irresponsibly during such events just because the property is insured. It is the responsibility of the insured to protect his property and avoid further loss. Utmost good faith. So let us discuss in a brief way about this doctrine, legal doctrine of utmost good faith. The doctrine of utmost good faith is a minimum standard that requires both the buyer and seller in a transaction act honestly toward each other and not mislead or withhold critical information from one another. The doctrine of utmost good faith applies to many common financial transactions. It is also known in its Latin form as uberime fide. Uberime fide. In the insurance market, the doctrine of utmost good faith requires the party seeking insurance discloses all relevant personal information. If you are applying for life insurance, you are required to disclose any previous health problems. The insurance agent selling you the coverage must disclose the critical information you need to know about your contract and its terms. The doctrine of utmost good faith provides general assurance that the parties involved in a transaction are being truthful and act in an ethical way. This can include ensuring all relevant information is available to both parties while negotiations are taking place or amounts are being determined. Good faith may also be exercised while completing various financial transactions. It can include a business or individual seeking finance from banking institutions, or when a financial institution provides a fee estimate as a real estate loan in the process. Often, estimates provide certain service providers are made in good faith. It refers to the fact the service provider, such as plumber or electrician, is confident in the cost estimate based on the known factors surrounding the transaction in case of repair. It is considered good faith only and not legally binding as it acknowledges that all variables are known. The representation through an application, concealment, warranty. So we have this principle of utmost good faith as a three important legal doctrines. One is representation, second one is concealment, and third one is warranty. Representation: details given by the proposer through application. In life insurance, the insured has to mention his following details in the application. He has to give his profession, income, age, family history, general health conditions, ailments suffered, medical reports, matters relating to conduct and character, any criminal record, etc. Assessment of severity of risk and the premium to be charged depend on the facts of representation through an application for insurance. In case of insurance, the products sold are intangible. Here, the required facts relate to the proposer that are very personal and known only to him. The law imposes a greater duty on the parties to an insurance contract. Those involved in commercial contracts, they need to have utmost good faith. The term material fact refers to every fact or information which has a bearing on the decisions which respect to the determination of the severity of risk involved and the amount of premium. The disclosure of material facts determines the terms of coverage of the policy. Any concealment of material facts may lead to negative repercussion on the functioning of the insurance company's normal business. Concealment. It may arise when the representations furnished by the customer, the details are incomplete, any important information is concealed or is misleading. The following are the facts must be disclosed. the facts which would influence the insurer in accepting or declining a risk or in fixing the premium or terms and conditions of the contract. The fact must be material at the date at which it should be communicated to the insurer. Facts which show the particular risk represents a greater exposure than would be expected from its nature. External factors which make the risk greater than would normally be expected. For example, diseases like BP, diabetes, which enhance the risk factor, previous losses and claims under other policies. Non-disclosure may be unintentional on the part of the insured. Even so, such a contract is rendered voidable at the insurance option and it can refuse any compensation. Any concealment of material facts is considered intentional. In this case also the policy is considered void. Warranty. In case where such minute details, statement of facts or promise made by the insured or expressly included in the insurance policy, active consent of both the parties, it is binding on both the parties to adhere to it. Only upon the fulfillment of those conditions, the insurer is bound by the contract. Warranties are collateral to the main purpose of the contract. They are secondary to the main covenants of the contract and form a condition cited by the insurer. Therefore, a person buying medical insurance cites regular all-round medical checkups and avails a lower premium based upon he has to do it regularly. In case if he discontinues his checkups in some instances, then it amounts to breach of contract and the insurer can take refuge in this and deny payment. Let us study about the legal provisions applicable to insurance business in India. Insurance Act 1938 is the primary law that governs the insurance business in India. It provides for the registration and licensing of insurers, payment of premiums, alteration and other policy matters, powers of governments, accounts and audit, other reporting requirement, mode of deposits, investments, constitution of claims settlement authorities. So all these are covered in the Insurance Act 1938. Coming to the Insurance Regulatory and Development Authority 1999, the Insurance Regulatory and Development Authority Act 1999 IRDA provides the establishment of an authority to protect the interests of holders of insurance policies, to regulate, promote and ensure orderly growth of the insurance industry and for matters connected therewith, and further to amend the Insurance Act 1938, the Life Insurance Corporation Act 1956 and the General Insurance Business Act 1972. Life Insurance Corporation Act 1956, Life Insurance Corporation Act 1956 and the regulations made there under deals with the formation of Life Insurance Corporation, LIC functions, powers, capital transfer of business, conduct of business and other related matters. General Insurance Business 1972. It deals with the formation of GIC, amalgamation of all the insurers existing prior to promulgation of the Act. It describes the powers and functions of GIC, powers of central government and other related issues. Motor Vehicles Act 1988. Motor Vehicles Act 1988 provides for compulsory insurance of motor vehicles. Act provides that no motor vehicle can be used in a public place unless there is a vehicle policy in force issued by an authorized insurer. This policy covers the insured person's liability in the event of death, bodily injury of certain persons or damage to property of third person. The Inland Stream Vessels Act 1917 and the Amended Act 1977. The Act provides that the provisions of Chapter 7 of the Motor Vehicles Act 1955 regarding insurance of mechanically propelled vessels against third party risks are applicable to stream vessels. The Act makes it compulsory for the owners or operators of inland vessels to insure against legal liability of death, bodily injury, or damage caused to the property of third persons and passengers. Marine Insurance Act 1963. Marine Insurance Act 1963 codifies the law relating to the conduct of marine insurance business in India. The provisions of the Act inter alia include provisions relating to basic insurance principles like indemnification, insurable interest, utmost good faith, subrogation, contribution, valuation, losses, warranties, return of premium, etc. The Carriage of Goods by Sea Act 1925. The Act defines the minimum rights, liabilities, and immunities of a ship owner on loss or damage to cargo. The Act deals with three aspects of a ship owner's liabilities towards cargo owner. The circumstances when the ship owner is deemed to be liable for loss or damage to cargo unless he proves otherwise. The circumstance when the ship owner is exempted from liability when loss or damage is caused by events outside his control, peril of the sea. The limits of liability of a ship owner for loss or damage to cargo calculated in monetary terms per package or unit of cargo. Now let us have an idea about the principle of proximate cause, and we can call it as causa proxima. Causa proxima is also known as principle of proximate cause. Causa proxima is necessary for a valid contract in insurance. It can be defined as the active, efficient cause that sets in motion to a train of events which brings about a result without the intervention of any force. It is concerned with how the loss or damage actually occurred and whether it is indeed a result of an insured peril and is payable under the affected policy issued by the concerned insurer. The loss of insured property can be caused by more than one cause in succession to another. The party may be insured against some cause and not against all causes. In such an instance, the proximate cause or the nearest cause of loss is to be found out. If the proximate cause is one of which is insured against, the insurance company is bound to pay the compensation and vice versa. When an insurance policy is bought, it is issued with respect to some peril which may result in loss to the policy holder. No policy covers all types of risks. The insurance company is liable to indemnify only against the insured perils. Proximate cause literally means the nearest cause or the direct cause. In insurance, it relates to the immediate cause of the mishap. In general insurance, there are numerous policies on vehicle insurance, property insurance, fire insurance, burglary insurance. Each policy offers protection from the risk that are mentioned in the policy. If a person has brought fire insurance for his house, protection will be from the loss caused by fire, which may have resulted from source mentioned in the policy. In case the fire occurs from any source other than the mentioned, the insurers are not liable to compensate the insured. For example, a cargo of oranges was insured against loss due to collision. The ship actually collided, resulted in delay and mishandling of cargo, made the oranges unfit for human consumption. The master of the rolls held that the damages to oranges were not the direct result of collision, but of delay and mishandling. As these causes were not insured, the insured could not recover the loss. Sugar was insured against the danger of seawater. Rats make a hole which causes the seawater to damage the goods. Though rats were originally responsible for the damage, the immediate cause of damage, the insured was entitled to the damage. Firemen remove the undamaged stock from a burning building to avoid its involvement in the fire. It is stacked in the open yard and subsequently damaged by rain. The proximate cause of the damage, the fire or rain. If the rain damage had occurred before the insured had an opportunity to protect it, then the proximate cause of the damage would be fire. However, if the stock were left unprotected for an unreasonably long period, the rain would be a new and an independent cause of damage. All the details related to proximate cause have to be clearly mentioned at the time of entering into the contract. Sometimes the causes not covered by the policy have to be expressly mentioned, and though it is impossible to mention the whole range of causes that are to be avoided, they are usually assumed by implication. The replenishment of compensation proceeds strictly depend upon the causes agreed upon. When the mishap occurs as a single event, the determination of proximate cause is simple, and that particular event can be attributed for the loss. In case where the loss occurs as a chain of events in succession, which one event setting off the other, it may be difficult to determine the exact cause of the damage. In such an eventuality, the parties have to carefully examine and find out the correct reason for the loss, the extent to which the loss has been caused by the proximate cause, and the amount of compensation to be paid based upon it. Many court judgments act as precedents in arriving the decisions while making settlements. When insurer is liable or when insurer is not liable. See, for example, when the peril is a single event, it is insured and it is insured. Insurer is liable. Where the excluded peril causes the insured peril and the events occur in a broken sequence, the insurer has to pay for the loss. Where both the perils are occurring concurrently and both the events are independent of each other, then the insurer is liable. Sometimes insurer is not liable. For example, where the excluded peril is the cause of the insured peril, they act consecutively. Where the insured peril is followed by the accepted peril and both cannot be distinguished from each other, where both the perils are occurring concurrently, at that time the insurer is not liable to pay any damage to the insured. So this is regarding the lesson insurance contract. We got an idea about the contract terms and also regarding the principles of insurance. So with this we conclude. Let us stop here. Thank you very much.